how do we get our money? We're not a bank. We're not a credit union. We have the same licensing as major banks. We have the same licensing as Wells Fargo. The difference is that we're privately funded. And this is why we can finance distressed properties. See, banks and credit unions can't. They're prohibited for the most part. And so they don't have that ability to go finance a lot of these distressed properties because they get their money from the FDIC. As such, they are governed by certain restrictions and what they can do. But we don't get our money from the FDIC. We get it from Zinc Income Fund. This is great. We have our own mortgage fund with a sub-REIT feature. It's fantastic. Investors invest their money in the Zinc Income Fund. Passively, they get a cash distribution every single month. It returns about 8%. So our investors in our fund earn 8%, fully secured fund, no losses. And then we take that money and then we lend it out to borrowers who are buying these properties with the intent of rehabilitating them and reselling them. So it's just, I got to tell you, it's super fascinating to me. We got a win-win-win-win.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Todd Pigott. Todd is the principal and president and oversees Zinc Financial and the Zinc Income Fund. Founded in 2007, Zinc Financial is a licensed lender having originated and serviced close to $1 billion in loans with a loss ratio of less than 0.1%. And in just a minute, we're going to speak with Todd Pigott about making money lending to fix and flip operators. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Todd Pigott. Welcome to CRE Radio.
Thank you very much for taking time to have me as a guest today on your show today. It's an honor to be here, and I hope that I could share some intel and some information that helps both you and your guests today. Thank you.
Well, I'm looking forward to our conversation, but before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. Originally born and raised in Southern California. My father was vice president of investments out of Pacific Life out of Newport Beach. Relocated here in the late 70s. I played a lot of water polo and swimming, eventually ended up at Fresno State with a degree in construction, real estate with an emphasis in finance. I owned a facilities maintenance company that I built from scratch when I was very poor. I built it up to 500 employees, servicing 3 states. I left the facilities maintenance company and my 500 employees in about 2006 and formed Zinc. The reason for forming Zinc is that's my passion. I'm extremely passionate about real estate investment and lending. Today, I preside over 3 entities: Zinc Auto Finance, indirect private money lender in the auto space, Zinc Investing, or Zinc Income Fund, rather, which is our mortgage fund with a sub-REIT feature. That fund is doing exceptionally well, no losses. And then, of course, Zinc Financial is our lending arm. We loan money to real estate investors that buy distressed assets with the intent of rehabilitating those properties, repositioning them, and then reselling them on the open market. We've done about $1 billion lifetime. I have myself fixed and flipped over $100 million myself. So I'm very active in the space of distressed assets, distressed lending, and it's been a quite a positive effect on both society, our borrowers, our investors, and obviously improving the neighborhoods for which we lend. That's a little bit about us and what we do.
Awesome. Appreciate you sharing that. So if I understood right, Zinc's been in business since you said 2000, was it 6 that you left?
2006 is when I sold my facilities maintenance company, to a private equity firm out of New York. And it was during that time that I decided I wanted to do something that I really enjoy. I don't want to own a grocery store or a car lot or a bar or a restaurant, for goodness sakes. My real passion involves in real estate. I had bought a number of properties in the multifamily as well as commercial sector, and I had rehabilitated those at that time. Probably in the late 90s to early 2000s is when I started doing that on a part-time basis. And so I did multifamily, commercial. My big success was in industrial. Industrial was outstanding for both cash flow, property maintenance, as well as tenant mix. That was our best success. So I had done those on a part-time basis, but I sold the company in 06. At that time, I decided that I wanted dedicated my full-time resources to real estate and finance. We did two things: bought properties, rehabilitated them, sold them. That was one division of our company. I did approximately 8 per month. I've done hundreds. And so that was really fascinating to me. I really, really enjoy taking a junky property, a janky property, mostly in the residential space, sometimes multifamily. These are houses, fire damage, water damage, REOs, dated properties, probate, whatever. That property is in disrepair. It cannot be sold conventionally. So in order for that property to be sold, it has to meet the conventional standards, primarily set by the federal government. We've all sold a house, and we've gotten that inspection report back before it can be sold. That you must fix the smoke alarm, and you must fix the cracked window, and the GFI doesn't work. So I did this. I actually bought these properties, I rehabilitated them, rent rolled them up and kept them, or I sold them. And so I did a lot of that after I sold my first company and really enjoyed it. I still enjoy it. But then we got into the lending arm. The lending arm is super fascinating as well. We lend money to real estate investors that find these distressed properties, whether it's small cap commercial, small multifamily, mostly residential, with the intent of rehabilitating those up to conventional standards and then reselling them to earn a profit. We actually track the sales price and the acquisition price as well as the rehab amounts. Our average borrower or investor earns somewhere between $30,000 and $80,000 per transaction. That's just approximate. But we became a lender to these real estate investors across the country. We're in about 45 states. And so we help borrowers or investors acquire these properties with the intent of rehabilitating and selling. So I'm now on the lending side. And of course, I've actually been an operator for probably the best part of 2 decades as well. So how do we get our money? How do we get our money? We're not a bank. We're not a credit union. We have the same licensing as major banks. We have the same licensing as Wells Fargo. The difference is that we're privately funded. And this is why we can finance distressed properties. See, banks and credit unions can't. They're prohibited for the most part. And so they don't have that ability to go finance a lot of these distressed properties because they get their money from the FDIC. As such, they are governed by certain restrictions and what they can do. But we don't get our money from the FDIC. We get it from Zinc Income Fund. This is great. We have our own mortgage fund with a sub-REIT feature. It's fantastic. Investors invest their money in the Zinc Income Fund. Passively, they get a cash distribution every single month. It returns about 8%. So our investors in our fund earn 8%, fully secured fund, no losses. And then we take that money and then we lend it out to borrowers who are buying these properties with the intent of rehabilitating them and reselling them. So it's just, I got to tell you, it's super fascinating to me. We got a win-win-win-win. What do I mean by that? Well, our investors that invest in our Zinc Income Fund, they're winning. They're in a fully secured fund, first position deed of trust on the underlying collateral. Our average LTV is about 65%. They earn passive income every single month of 8%. Furthermore, our fund has a 20% tax deduction because it has a sub-REIT feature. So 20% of the distributions are have a tax deduction. So you're only taxed on 80% of the distributions. So our investors in our fund win because they get passively earning 8% with a 20% deduction. Then our borrowers, which are the real estate investors, they win. They buy this janky property, probate, fire, REO, whatever. They turn around, they repair that, get it up to conventional standards, rent roll it up. They make a little bit of money. So our investors make 8% passively, approximately. The guys we loan money to, they make 30 to 80,000. And then look at this. We have a first-time home buyer. There's such a shortage of housing across the nation. We have a first-time home buyer that's now has the ability to buy this newly rehabbed house. They're excited. They're in tears. They love it. Finally, we improved the neighborhood. These are drug houses. These are REOs. Christmas lights are still up. The yard's overgrown by 24 inches. Old junky cars in the driveway with a bunch of tires stacked beside it. That's the house or property that we're taking over. And the neighborhood loves it because our investor cuts the grass, takes down the Christmas lights, puts a fresh coat of paint on it, puts some new windows in, fixes up the yard, completely remodels the inside, and improves the neighborhood. So it really is a cool thing that I do here. We improve the neighborhoods, they win, provide a first-time home buyer with a new entry-level home or multifamily or small cap commercial. Our investors win because they're earning 8% passively. It's a fully secured fund. And finally, I win. I make a few bucks on the side. So that's a little bit about us. And if I could add to that, I think today's a ripe opportunity for this. There's a lot of dynamics out there that are shifting. We have high interest rates. We have inflation. We have some currency concern, whatever. There's a lot of dynamics today that are out there. But I'll tell you one thing that's really in our favor right now. And that is we have a shortage of housing. Across the country, believe it or not, housing has not depreciated that much. As a matter of fact, in Central California last month alone, 50% of the houses actually sold above asking price. So still competitive demand right now. Our average time on market across the country is between 1 and 2 months. That's still historically low. So we're not seeing the depreciation cycle that one might expect or that you hear about on major internet cycles. That's not occurring. We have stabilized high prices, mostly due to shortage of inventory, lack of affordable housing. This is keeping prices and inventory, or rather prices, elevated throughout the country. There is a need for our product class. So with all the dynamics out there and the risk associated there, this is what I would consider a safe investment for today's climate.
Yeah, let me ask you a few questions there, and I appreciate you kind of going through that because it clearly outlined all the levels of opportunity that you guys work with. So your investors, the people that invest capital in the fund, is there a minimum investment limit?
Absolutely, there is a minimum investment.
Okay. What's the minimum?
This is a registered fund with the SEC, mortgage fund. It's a debt fund. And so the minimum investment is $50,000. It's open only to accredited investors. We are fully registered with the SEC. We are fully audited by one of the largest fund auditing firms in the country. Our legal is done by Gerasi out of Irvine, one of the largest private money fund operators. And then, of course, we have Verivest up in Oregon. They provide all of our compliance and licensing. So we're heavily watched, heavily regulated. It's a $50,000 minimum investment for our investors in the fund, but it is a fully secured debt fund. So all of the capital is fully secured with first position liens against the underlying collateral.
Got it. So, and how long has the fund been in existence? Yeah,
so Zinc was formed about 18 years ago after I sold my previous entity. Our fund has been in existence for approximately 2.5 years. Prior to that, we used our own money or we used credit lines. But I had such a demand for investors wanting to participate with me in both the lending arm as well as the individual fix and flips that we formed a fund. The fund has proved to be very, very beneficial for both them and us. And with that 20% tax deduction, that's a real neat trick. That was signed into law in 2017 by President Trump. And so that 20% tax deduction also provides just a real favorable benefit, which makes it, highly sought after and highly desirable. There's also two other, if I could add, two other tax strategies that Trump signed into law in 2017. Number two, IRA funds are no longer subject to UBIT tax. There was a tax and a tax return that must be done prior to the signing of the law for investors who put their IRA money to work in a fund. President Trump removed that. So people that put their IRA money into our fund, they're no longer subject to a UBIT tax, unqualified business income tax, and they're no longer subject to a tax return. Finally, the third strategy that was employed was residents that are out of state in a favorable tax state, call it Texas or Nevada. They're taxed in the state that they reside, even though the income is generated in California. So previous to this law, if you earned income in California, you had to pay the taxes associated with that income. Today, if you reside in a favorable tax state, you don't have to do that. So we took advantage of these laws in 2017 that were signed into play. A 20% tax deduction. B, if you're out of state in a favorable tax state, you're taxed in a state that you reside in, even though the income is earned in California on California real estate. And then C, if you invest your IRA money, you're no longer subject to UBIT tax. Trump signed all these into law. Congress approved them. And so these benefits are something that we take advantage of. And that's how we structured our SEC, a mortgage fund, which is a debt fund, for these benefits. So yes, my investors realize these benefits. They love them. It's very, very good for them. And again, it's a fully secured vehicle with the first position deeds of trust against the underlying properties. I hope that helps you.
Yeah, no, that's great. The 20% on the tax thing, is there any? Can you expand on that just a little bit? I'm not familiar with how that works.
Absolutely, it's a 199A. That is the IRS code. And so what happens here is it's very hard to get approved, but we did it very hard. We have our mortgage fund, which is registered with the SEC, and then we built a REIT within that fund. And that REIT within the fund, or sometimes called a sub-REIT, enables us to take advantage of a tax strategy provided for by the IRS and the SEC called 199A. Now, what that means is if you invest money into our fund, and let's say you get distributions every month. Let's just say you get distributions every month of $10,000 in cash or 120 grand a year. You're only taxed on 80% at the federal level. At the federal level, you're only taxed on 80% of the distributions from our fund at the federal level. So if you earned $100,000 from our fund over a fiscal year, you're only going to be taxed on 80,000, even though you actually received 100,000. So this is extremely beneficial for our distribution and our investors. And then on top of that, if you lived in Texas or Nevada or whatever, a tax favorable state, if you don't have the personal income tax state in your state, and you get a 20% deduction on federal, that's a win-win. So very, very good for our investors. 8% fully secured. Then of that 8%, you're only taxed on 80% of that. And then, of course, if you're in a tax favorable state, like for instance, Texas, then you don't even pay on the state side. So that's how that works a little. It's called a 199A. Signed into law back in 2017.
I appreciate you sharing a little bit more on that. I'm sure the listeners will appreciate that. The other thing I wanted to ask you about, you mentioned the UBIT penalty. I know previously I talked with other investors. I guess it's been a little while since I've talked with anybody about specifically the benefit from the Trump tax law. How is it? So because I'm assuming a lot of your investors are using some retirement funds, 401k funds, self-directed IRA type stuff. And now there's no penalty when investing in something where there's actually a lien against the property, or
so about half of our investors in our fund use their retirement 401k, IRA, whatever. Now, I'd like to preface this with I'm not a tax attorney and I'm not a CPA.
Sure.
But from a high level view, when participants invested their IRA money or retirement savings in a vehicle, they used to have to do what's called a UBIT tax, UBIT, unqualified business income tax. Again, I'm not a tax attorney or a CPA, but there was a tax associated with you investing your IRA money. Furthermore, you had to actually do a tax return. So you had to, if you invested your IRA or your 401k into a fund like ours, you had to do a tax return at the end of the year, and then you had to pay some tax and some fees called UBIT tax. In 2017, 2018, somewhere in that range, President Trump removed that. And now, as part of the IRS code, if you invest your IRA in a fund like ours, you no longer have to do a separate tax return, and you no longer are subject to the UBIT tax. So this, again, is extremely beneficial. So if somebody has an IRA, they want to put it into our fund, number one, it's fully secured because all first position liens are held by the fund. Number two, you're not subject to the UBIT tax or even a tax return. So if people have IRA money, it's a safe haven to put it in a fund like ours, very secure, great returns, above market returns. You have the safety, and then you no longer have that UBIT tax issue. So I think that's been a real positive thing that's happened at the federal level that Trump was able to get through Congress. And of course, we're taking advantage of this. Again, difficult to get done, takes a lot of lawyers. We invested a lot in this, but we did get it approved, and it's something that we're very proud of.
No, that's great. I appreciate you providing more info on that. As far as it being a fund, I know like if somebody's investing in like a syndication or something like, actually in the property, you're locked up in that property until the investment sells or has some sort of liquidation event or a refi. If one invests in your fund and they're in there for a period of time and they want out, is that an easy call to get their money back, or what's the options for that?
First of all, that's a fantastic question, and I'm glad you brought it up. A lot of REITs out there and a lot of funds out there are asset funds. In other words, you put your money in, and there's all these wonderful projections, but really your money's in there until that asset is repositioned or sold. It can be years. It can be 7 years until that shopping center or the apartment complex or whatever, until you realize your profit. A lot of those funds, honestly, have very lofty projections, very lofty performance. You're locked in for long periods of time. And it's very difficult to extract because that asset is just illiquid. So I don't like those funds because they often have lofty projections that are never realized, and you're locked in there for years and years and years. And then at the end of 7 years, you often have much less than what you thought you were going to get at the beginning. Our fund's a debt fund. As the money comes in, we lend that money out to real estate investors with high FICOs and good cash reserves and great properties. And so that money's coming in every single month. Our distributions are every single month. You're not waiting 7 years. You're not waiting anything. The second you're in, the second those distributions come through. Your question is, how easy is it to get the money out? We do have a 12-month lockup. It's absolutely the minimum that's available at the IRS level. Anything less than that, it becomes a securities issue. If it's anything less than that, it's rated as securities and it's taxed differently and it's structured differently. 12 months is the minimum. Another thing with the 12-month lockup is our loans are about 9 months. So if somebody comes into our fund, obviously we've loaned that money out, and that money is now tied up in a loan for 9 months. So if they want their money back, no problem. There is a 12-month lockup. However, I will tell you that in the event of calamity, for personal calamity, i.e. medical or some kind of urgent need by an investor, we can almost always get them out earlier. Of all the investors we've had, we have never lost ever an investor to a performance issue or conflict. The only investors that we have lost, candidly, have been over medical or personal reasons, like a health issue or a divorce or something like that. So, and with those investors that are in a time of need, we've been able to return their money in whole pretty quickly. But we want to do that. If somebody's in a situation, in need, we want to take care of them as quickly as possible. And we've always been able to do that. But by the letter of the offering circular, or the PPM rather, we do have a 12-month lockup. That money is out in loans. As that money is returned to us, then of course we can take them out immediately.
No, that's great. Hey, I wanted to ask you a little bit about the borrowers.
Sure.
So you guys lend nationwide, or pretty much nationwide, is that right?
Well, I would say we're predominantly nationwide.
Okay.
We're very heavy in non-judicial states. We're a little bit less present in judicial states. That means that in a judicial state, the foreclosure laws are a little bit tougher to get through. You actually have a court, that you have to go through. Non-judicial, to get our collateral back in the event of default, it's very quick and simple. So we're very, very aggressive in non-judicial states. So in the event of a default, we're able to, get to our equity relatively quickly. We are in 43 states across the country. Mostly nationwide is where we lend to our borrowers.
And as far as the underwriting for a borrower, how do you guys, or what's your box that you look for as far as property, location, the borrower's experience, size of loan, all that fun stuff?
I love that question. I love it. We are very, very strict here. Very strict. I have my own money in this fund. I have my friends and family's money in this fund. Furthermore, and listen to this, I posted $500,000 in cash. That's held at the fund level. I'm in a first loss position before any of my investors would ever lose a dime. So our offering circular has Todd Pigott, myself, as a first position loss with $500,000 already at the fund. So because of this, because I'm personally invested in this and I've already deposited $500,000 in cash, I am heavily, heavily invested in our product. With that said, our underwriting is extremely strict. Why? Because I'm heavily invested in this alongside my investors, and I posted a $500,000 cash at the fund level, guaranteeing my investors that I would lose that before they're even touched. So our underwriting is very strict, both at the property as well as the borrower level. We're heavily credit driven. We're connected here to all three credit bureaus. We're also connected directly to the IRS, and we're also connected to background checks, the same database used by fire and courts. So we run a full background check on any borrower. We actually go to the Social Security Administration and check their Social Security, and we run a tri-merge credit report. Our credit box matrix for our borrower, our average borrower has a 710 FICO. These are prime borrowers. Our average borrower has 20% cash down on the subject property that they're invested in. So they're heavily invested. That 20% usually represents over half of their net worth. So we have a good credit borrower with a good job, with a good, what I call meaningful cash alignment of interest. We are not a hard money lender. We're a private money lender. We're close to the credit union spectrum of lending from a credit box. We're very, very particular. 80% of our submissions are declined because the borrower does not meet our credit matrix. You must have good credit. You must have a good job. You must have a good, meaningful cash alignment of interest with us by 10 to 20% down on the underlying transaction. Why am I so strict on credit? We loan money on distressed assets, not distressed people. I've been doing this for a very long time. I've done $1 billion of it, and I've learned one thing. I cannot fix bad people. They're set in their ways at age 15. It's not going to happen. And so we just don't loan money to bad people. We loan money to bad, ugly properties. Those can be fixed. So with that, we're very aggressive on our credit underwriting matrices with our borrower. They must have cash. They must have good credit. They must have a clean background, and they must have exposure to this industry. The collateral, I'd like to speak to that. We're very strict there as well. What type of collateral do we lend on? We lend primarily on housing. We do commercial. We do multifamily. But 85% of our loan product is entry-level housing. Why? Entry-level housing is very easy to liquidate in times of need. Everybody needs a house. And so we focus on housing below the median cost of housing. We focus on it in geographical regions where there's a population of at least 50,000 people. I call it my curbs and gutter theory. It must be an entry-level house in a geography where there's a 50,000 person population. My curbs and gutter theory refers to the elevation of the house and the location. We're looking for sidewalks, neighborhoods, close to a Starbucks, a McDonald's, a church, and a school. There must be a, i.e., curb and gutter. Is it on a street? Is it in a conforming neighborhood with a conforming elevation that's below the median cost of housing? Why do I like that asset class? I'll tell you. In any type of distressed economy or distressed market or distressed anything, I can always liquidate an entry-level home below the median cost of housing in a solid neighborhood next to a McDonald's, a church, or a schoolyard. That is the easiest collateral in the world for me to liquidate. Now, commercial, much more difficult. I've been in commercial. I do commercial. But I'll tell you what, that is harder to liquidate in times of distress. So commercial is a little bit touchy for me. Multifamily, a little bit touchy, but an entry-level house in a good solid neighborhood in a desirable area in a desirable community is very easy for us to move. So our underwriting conditions are very strict on the collateral and very strict on the borrower. We don't do ranches. We don't do rural, desert, mountains, vacation homes. Simple to understand, simple to evaluate, simple to appraise, simple to affix a value on, entry-level housing, below the median cost of housing. That's what's in our fund predominantly, and that's the safest asset class that I can determine for our investors as well as myself.
So you mentioned the average duration around 9 months. You mentioned kind of the location thing. I appreciate you getting into that. What's an average loan amount? You mentioned 20% down, but entry level homes, I mean, depending on where you're at, can range from, that's all to, oh my God, depending on the zip code. What's an average loan size that you guys lend?
Our average loan size is just under $400,000. A lot of our lending is done in California, and that's a larger loan size. It's actually less risky. So people sometimes have this false sense of security that doing smaller loans is more granular and less risky. It's actually the opposite. A $1.8 million home in San Francisco, believe it or not, I mean, despite the news and despite everything that you see from tabloid perspective, I can liquidate that house in 2 weeks. So the higher the loan, believe it or not, is sometimes safer because the desirability, I call it the absorption rate. What do I mean by that? The absorption rate in that community is so high, is so prevalent that I can easily liquidate that in a time of need. So San Jose, the average home there is 1.5 million right now. The absorption rate is phenomenal. I can get out of anything in days. Now, I did some loans in Ohio. 3 homes, $40,000 each. I'm not speaking negatively about Ohio, but those 3 loans that are $40,000 each might seem less risky. They're actually more risky because the absorption rate in these communities in Ohio is poor. So I would rather do a 1.5 million in San Jose than a 40,000 in Ohio. And so the absorption rate in that community is paramount to our lending criteria. And candidly, the more expensive areas are likely higher absorption rate, more demand, and therefore easier from a valuation standpoint and a liquidation strategy to place our money.
Yeah, no, I get it. With the demand, you've always got an exit. No demand, you got maybe a long-term hold you didn't count on.
Correct.
So the average loan size, 9 months, what is it pretty much resurfacing, the carpet, walls, fixtures, kitchen, bath, maybe a roof, windows. Is that kind of the list of things, or do you get into anything that's more substantial, whether adding square footage or a tear down or?
That's another great question. So we're very collateral heavy on underwriting as well. So once we've identified that the borrower has met our credit matrix, they have good cash, they have good credit, we've done a background, they're good, they have good exposure. Once that's been completed, then we're into the collateral. Is that property in a good geography location, curbs and gutters theory, good elevation, etc.? Now let's look at the property itself. What does it need? An eyeball high-level picture. We look for a property where the rehab is going to be 10 to 30% of the acquisition price. Why? If they're doing too little improvements to the property, that's a danger zone for us. What's your value add? If you're just going to do paint and carpet, that is typically not enough to create value. So anything less than 10%, we show concern. Anything over 30%, we also get concerned, because the rehab is so heavy that you're getting into things that don't return in value. So we look for properties where most of the work, most of the value add is going to be in cosmetic. Paint, carpet, cabinetry, granite counters, new plumbing, new lighting, new fixtures, new baseboards, revitalize, complete remodel of the bathroom. We do get a little bit concerned if they're going to get into HVAC, framing, fencing, pool, concrete. Why? Because if you're doing concrete, roofing, or HVAC, these are not items that can create a lot of return. You put in $12,000 in HVAC, but nobody pulls up to that house and says, honey, look at that. Isn't that a wonderful new unit on the roof? That doesn't happen. So you put that $12,000 into a new HVAC unit, but you might get back just that. So we don't like rehabs that are really heavy, with heavy bones that need to be improved, i.e. framing, HVAC, roofing, stuff like that. We like properties that are in moderate to heavy rehab, but that rehabilitation is concentrated mostly on cosmetic features. Drywall in is, I guess, what I would say. The drywall in is the simplest to fix. It's the easiest, and it creates the most value lift. New finished plumbing, new finished lighting, new cabinets, granite, new dishwasher, new appliances. You can get an 8x return on those contributions. Where a roof that's $12,000, you might get back just $12,000. So from a property perspective, we look at moderate rehabs. We don't like super heavy rehabs, and we don't like minor rehabs either, because there is no value creation. And so we're very tight on those areas as well.
Got it. As long as I can remember, the fix and flip thing has been a model. I know I've got clients that used to go to the courthouse steps and buy at auction, distressed properties, fix them up and sell them. And then I think post 2008 there was a really big wave with all the bank foreclosures and stuff. You mentioned earlier that you think this is a really good time based on the demand. I'm curious, from your vantage point, has anything changed as interest rates are creeping up overall? Just the change in the marketplace. What's your thought on, from today forward in the near future?
I will tell you that your question is great. Todd, what is your prediction? Interest rates are rising. You have friends, I have friends. I was actually one of the largest purchasers of homes at the auction for foreclosures down there on the trustee sale. Todd, what's your prediction on where housing is going from a collateral and evaluation standpoint? I speak on this topic often at conferences, and so I'm gonna delve a little bit deep into the details here, but I'll try to move it along swiftly. First of all, I'm very, very data driven, metric driven. I do not get my data from tabloids, TV, or the internet. I pay for it, and I get it from two sources. I get it from the General Services Administration at the federal level and the National Association of Realtors. And this is how I track housing. I go to the GSA, and I pay a lot of money for data metrics on the servicing centers across the nation. The General Services Administration tracks servicing of housing portfolios about 80% of the nation. And what I do is I drill down into the spreadsheets and I look for stress points. And here's what I'm looking for. My definition of a stress point is calls coming into servicing centers for stress. I have this data directly from the GSA. When a call comes into a servicing center for a pick a payment, foreclosure avoidance, loan modification, I can't make my payment, I need help, whatever. All of these calls are tracked. Most people don't know this. And so all these calls are tracked, every one of them, by the federal government, and then they're put into ratios. And then I take those and I put them into graph form. Number one, the last 2 months, we have had a 50-year low of people calling in to servicing for foreclosure avoidance, pick a payment, a loan modification, etc. 0.4% of call volume tracked by the GSA was at stress points. What I'm conveying, we do not have a wave of people calling in saying, I'm in trouble, what can I do? Today's borrower is simply this. They're performing at the highest level in 50 years. Number two, we have record equity that is also at the highest point in almost a half a century. Number three, mortgages today are out there are in the 2s and 3s. What this has created is a huge burden for inventory. There are not foreclosures coming onto the market as of today. It's not. The servicing volume is telling me that the calls coming in for stress points is at an all-time low. Simply put, mortgages are performing at one of the highest levels in 50 years. On top of that, people are not moving. They're not moving up. Why? Because they're in a 2.7% mortgage loan. And if they do move up, they're going to pay, yesterday I heard 7.75%. So instead of moving, they're just adding a bathroom or adding a red room or stacking the kids on top of each other as opposed to getting another house with bigger and better. So this is restricting inventory. At the federal level, we don't have that inventory of foreclosures coming. We do not have that coming. Secondly, we have move-up buyers or transplants that are not moving either because they're in a 2.7% loan. As a result of these things that I watch and pull, we have tight supply really across the nation, which is keeping prices elevated. Right now, and this is fascinating to watch media outlets. Fascinating. Offers. I read this on CNN. Offers were down, 35%. Well, I'll tell you, I looked at this nationwide last year at this time. The average home sold for 104% of list price. Today, almost 2/3 of the country is between 98 and 99. Now, CNN or the news outlets will post this as a huge problem. My gosh, housing is dropping off, and it's no, ladies and gentlemen. I track this. I get that data. We went from 104% of list price down to 98 and 99. Housing is still moving at list price. That is not a collapse. Furthermore, the percentage of housing that is sold above asking price is still at a very, very high level right now. California alone is 50%. Why? We have constricted inventory. So my prediction is, and this is my prediction, housing will stay constricted. Prices will remain elevated, even with interest rates at 7%. The velocity and the absorption rate out there is still at a very, very sustained level. I remember 07 and 08. I remember the 05 recession. I remember the 96 recession when I got out of college. This is different. We have short supply of housing. We don't have a wave of foreclosures coming. For that reason, I predict that housing will be relatively stable. We might have dips of depreciation. For instance, San Francisco's dipped about 4 to 5%, but it's not dipping to the levels that the news outlets would be predicting you from like the 07 and 08. Let me share with you this. I was very, very heavy in this in the 08 collapse. Very heavy in it. The HAMP program came out, and I argued that that program would be a failure, and it is a failure. At that point in time, I bought a lot of properties, hundreds of properties, and I did a lot of evictions. Every single property that I personally went to that knocked on the door from a eviction standpoint was not a borrower in distress. That was a borrower that did not want to keep their house strictly from an equity standpoint. I took over hundreds of properties myself in 08. None of them were from somebody that lost their job or couldn't make the payment. They all could make the payment. They just didn't want the house because it was worth 400 and they paid 600 for it. Today, we don't have that issue. Since 08, the mortgage has changed. 91% of mortgages today are underwritten by the federal government, Fannie, Freddie, FHA. All of those loans are full doc loans. So all of those loans at the servicing centers, which I spoke about earlier, are fully performing full doc 30-year amortized loans. As a result, last month, the stress points that came into the call centers was only 0.4%. Why? These are full doc loans with equity, with people that can afford them. And therefore, we have high performance of these portfolios. Back in 08, we had pick a payment loans, negative AM loans, no doc loans, stated income loans, stated asset loans, stated everything loans. Those loans were not performing. There was no equity. They couldn't do it. And so that the mortgage today is different. And for that reason, the performance level of the mortgage is different. And for that reason, we don't have this wave of foreclosures coming. It's going to keep inventory restricted, therefore values elevated. And I think for that reason, it's a very safe place to put our money today.
No, I think you're right. There's going to be some other stress and other cracks that will reveal themselves, but I think you're head on there, or spot on there. Hey, Todd, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. When we cannot avoid it, we look to see if there is a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a
You're absolutely right. Great
transfer vehicle. Yeah.
Great elaboration. You're absolutely right.
So I like to ask my guests if they can look at their own situation. Could be your clients, the Fed, political winds, whatever it is that you see in your business, in your situation, that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Todd Pigott, what is the biggest risk?
In my opinion, and I evaluate that all the time, what's our biggest risk? I manage $100 million right now, other people's money throughout our fund. What's the risk that I'm trying to avoid? I can predict the interest rates. I can look at the metrics provided by the GSA for portfolio performance and assess risk there. I can look at absorption rates and assess risk there. I can look at the borrower, got good cash down, got good credit, background's clean. I can assess risk there. My biggest concern of risk in what I do every single day, and I think if there's any time for this to happen, it's now. My biggest risk that I view as a potential threat to my specific platform is a calamity outside of housing that will cause housing or real estate to collapse. I believe that housing today is extremely safe. We have 1.8 months of inventory. We have constriction. We don't have a wave of foreclosures. We have a shortage of housing, and all these point to stability right now, except for little pockets here and there, down 5%. 99% of list prices under 4. My biggest concern is a calamity outside of housing that will quickly affect housing. A terror attack, political dysfunction, a drop in our currency, war. everybody can call me a crazy for these things, but I believe that in 2023, the chances of some type of calamity occurring outside of housing or real estate that will affect housing or real estate is likely. And I think that we're seeing some of that. We're seeing things happen politically, society, currency, or even globally. We're seeing things happen that we've never seen in our lifetime. And so I think if one of those events occurs, that would send housing into a spiral. And so here's how I look at this, though. That is something that I don't have control over. I don't know what's going to happen there. And if it does happen, I tell my investors this. Our worst scenario is that we have a cataclysmic event outside of housing that causes a deep decline in asset values across the nation, both in stocks and everything else. So what do? I tell them this: at least I've got real estate. I've got a home with a first position lien where a borrower with good credit put down 20%. I can get in my pickup truck and drive to that property, and we at least have that. So he bought it for $400. He put down 60 to 80. We're into it 320. We thought it was going to be worth 550, and the whole world fell apart. At least we can get in our pickup truck and drive to that property, and I've got a property that somebody has to live in. We will, freeze the fund, freeze it, and we will be renting those or holding those for cash flow as entry-level housing until that calamity starts to dissipate. So my investors who come and say, what's the worst thing that can happen? The worst thing that can happen is a calamity outside of housing. At that time, we would at least freeze the fund, and we would at least have assets that we would stabilize with renters for positive cash flow until that calamity dissipates. So that's how I plan on mitigating that risk threat. And I think that risk threat is potentially real, Something out there is going to happen 5 years, 10 years, 3 years, I don't know, that's going to cause a discourse and affect us. I don't have control over that. You don't have control over that. But the best way to protect about that is at least have some type of plan B or exit strategy, and we do.
Awesome. Todd, where can the listeners go if they'd like to learn more or connect with you?
That is, gosh darn happy to share that. And thank you for allowing me that opportunity. For investors that might want to consider our fund, it's a fully secured fund. It's a debt fund with monthly cash distributions, 8%, with great tax benefits. I'd like to invite them to zincinvesting.com, ZINC investing.com, or they can reach us here at the office, 559-326-2509. If there's a borrower out there that is looking for capital to fund a distressed property that they want to buy and reposition and fix and flip, whether it be commercial, multifamily, or residential, and we're very heavy on residential, they can visit us at zincfinancial.com or give us a call at the office at 559-326-2509. I'm Todd Pigott. I'm the principal and president of Zinc Financial. I'm the managing member of the Zinc Income Fund.
Awesome. Todd Pigott, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you very much for taking time to have me today. I hope your listeners got something from this.
Awesome. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all I've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.